On paper, the US dollar is like the undisputed heavyweight champion of the world right now. I mean, if you look at the global financial charts today, April 4th, 2026, the dollar is sitting near multi-year highs.
Yeah, absolutely. It looks practically invincible.
Right. But, and this is a huge, but if you step away from that macroeconomic data and just, look at your own bank account, you are probably feeling an undeniable, almost invisible squeeze.
Oh, for sure.
People are just feeling stretched to the absolute limit. And at the exact same time, the world's biggest central banks are quietly hoarding massive amounts of hard assets to hedge their bets against the very system they control.
Which is a profound disconnect.
Yeah.
It really highlights the danger of relying purely on headline metrics.
Totally.
Because you have the foreign exchange markets painting this picture of absolute impenetrable strength, but then the microeconomic reality, like the actual lived experience of households trying to pay for utilities or groceries, that is painting a completely different picture.
Okay, let's unpack this. Our mission today for this deep dive is to pull apart this paradox.
Right.
We really need to separate the tactical short-term strength of the dollar from the slow-moving structural cracks that are forming underneath it. And ultimately, we need to figure out what those cracks mean for your hard-earned savings.
Exactly. That's the core issue.
So to do that, we are leaning into some incredibly detailed new market analysis by veteran financial researcher Doug Young. He just published a piece examining whether the almighty dollar is, well, finally cracking.
It's a fantastic piece of research, honestly.
Yeah, it really is. And we are also pulling data from recent April 2026 financial headlines. Plus, we're looking at the latest institutional moves tracked in the Gold IRA comparison guide.
Which is really the perfect framework for this conversation. Because when we talk about the dollar cracking, it is crucial to set the stakes accurately right out of the gate.
Right. We aren't talking about doomsday here.
Exactly. This isn't about an overnight economic collapse or like hyperinflation where you wake up tomorrow and your money is suddenly worthless.
Right. You can still buy a coffee.
Yeah. The risk you actually need to be paying attention to is the gradual hidden erosion of your purchasing power over time. It's a slow leak in the foundation, not a sudden earthquake.
Well, let's start by looking at that foundation, because if you turn on any financial news network right now, you're going to hear endless commentary about the strong dollar.
Oh, nonstop.
So why is it commanding such a premium on paper right now? Like, when investors say it's a safe haven, what does that actually look like mechanically?
Well, it really comes down to how global capital behaves during periods of stress. So whenever there is geopolitical uncertainty, war risk, or energy price volatility, global investors panic.
Naturally.
Right. And when they panic, they rush to safety. Historically, safety means shifting capital into liquid dollar-denominated instruments.
Okay, let's define that for the listener real quick. What exactly is a liquid dollar-denominated instrument?
Think of it primarily as U.S. Treasury bonds. Investors want an asset they can park billions of dollars into on a Monday and then sell on a Tuesday for cash without crashing the price of the asset itself.
So it's about speed and scale.
Precisely. The U.S. Treasury market is the deepest, most easily tradable market in the world. Combine that with a U.S. monetary policy that remains relatively tight compared to other major economies, meaning interest rates here offer a decent yield, and the dollar just naturally becomes the default emergency destination for global capital.
So if we look at the global economy as, say, a ship taking on water, the U.S. dollar isn't necessarily a luxury yacht. It is just the biggest life raft on board.
That's a great analogy.
Yeah, everyone jumps into it when they get scared, which makes it look incredibly valuable. But that raft still has a slow leak.
That is a highly accurate way to visualize it. I mean, the rallies we see in the dollar's value against other currencies, those are tactical. They reflect temporary shifts in investor sentiment and fear.
Right, fear being the key word.
Exactly. They do not mean the underlying structural issues of the U.S. economy have somehow magically been resolved.
And that brings us to the leak in the raft. That invisible squeeze you and I feel every day. In his recent analysis, Doug Young points out that over the past century, the real purchasing power of the dollar has plummeted.
Drastically.
Yeah. I mean, a dollar from the 1910s buys a microscopic fraction of what it used to, but humans aren't really built to feel a century of inflation day to day. We adapt.
Right. It's too slow to notice on a Tuesday.
Exactly. But what we do feel acutely is what happened in the early 2020s. We experienced this massive compression where several decades worth of normal price hikes were basically packed into an incredibly short window.
What's fascinating here is the mechanics of how that compression permanently alters your reality.
Yeah.
There's a fundamental difference between the rate of inflation slowing down and prices actually returning to normal.
Oh, that's a huge point. Deflation versus disinflation.
Exactly.
Yeah.
When we talk about the gap between nominal income, meaning the actual number printed on your paycheck,
Yeah.
and real-world costs, that is where the erosion lives.
Yeah.
Even when the headline inflation numbers cool down to, 2 or 3%, the cumulative damage is permanently locked into the system.
Right, because a cooler inflation rate just means prices are growing slightly slower from a new, painfully high baseline.
Correct.
So if your grocery bill went up 40% over 3 years and your wages only went up, say, 15%, your budget has structurally shrunk. You are permanently poorer in terms of what your labor can actually buy.
And that structural shrinkage is the microeconomic reality. You don't feel the dollar's strength on a foreign exchange chart. You feel its weakness at the gas pump, in your healthcare premiums, and in your insurance costs.
So naturally, the question you have to ask is, if this loss of purchasing power is the central problem destroying the middle class, why doesn't the government just deploy the traditional fix?
The Volcker fix.
Right. Why don't they just aggressively hike interest rates into the double digits to crush the inflation, just like Federal Reserve Chairman Paul Volcker did in the early 1980s? We hear about the 1980s playbook all the time as the ultimate cure for inflation.
If we connect this to the bigger picture, you will see exactly why the 1980s playbook is completely broken today.
Okay, let's hear it.
The primary constraint is the sheer scale of the national debt. When Volcker hiked rates to nearly 20% in the early 1980s, the U.S. public sector debt was roughly 30% of the overall gross domestic product.
30%.
Right. Today, U.S. gross federal debt is well over 120% of our annual economic output, and it's projected to climb into the low 130s.
Wow. Just to put that into perspective for everyone, we haven't seen debt levels like that since the immediate aftermath of World War II.
That's right.
But back then, we had the post-war industrial boom to, actually grow our way out of it.
Precisely the opposite of today's demographic and productivity trends. So, let's look at the mechanics of what happens when debt is that massive. The government becomes incredibly hypersensitive to interest rate changes.
Because their borrowing costs go up.
Exactly. They have to constantly issue new debt just to pay the interest on the old debt.
Man, it's like a homeowner trying to manage an exploding variable rate credit card by taking out another credit card just to cover the minimum payment.
It's exactly like that.
Eventually, the minimum payment alone consumes the entire paycheck.
That is the exact mathematical trap we're in.
Yeah.
It certainly feels like a win when you see that interest payment hit your account at the end of the month. But we have to look at the math of real returns.
Okay.
This is the crucial distinction between a nominal return and an inflation-adjusted return. Let's walk through the mechanics. Say your savings account pays you 5%.
Nice and easy math.
Right. You put in $10,000 and you make $500. But the real-world inflation rate for the specific basket of goods your household requires to survive is rising at, say, 6%.
Ah, I see where this is going. So the things I need to buy now cost $600 more than they did last year.
Correct. You made $500, but your costs went up by $600. You are already in the red.
Ouch.
But it actually gets worse because the IRS taxes your nominal gains. You owe taxes on that $500 of interest you earned, even though your purchasing power actually shrank.
That is brutal.
It is. After accounting for taxes and the real inflation rate, your effective return is deeply negative.
So you are effectively paying taxes on the privilege of losing money slightly slower than everyone else.
That is a brutally accurate way to phrase it, yeah. You are quietly bleeding purchasing power while the statements from your bank make you feel like you're somehow getting ahead.
Wow.
And this mathematical reality is exactly why policymakers are trapped. If the Federal Reserve hikes rates aggressively to kill inflation, the government's own interest bill skyrockets, public finances buckle, and you trigger a massive recession.
Right.
But if they lower rates to ease the government's debt burden, inflation reignites, and everyday savers get crushed even faster. There is no clean exit from a heavily indebted system.
Here's where it gets really interesting, though. If everyday households are caught in this squeeze, bleeding purchasing power, the massive global players definitely see the math on the wall.
Oh, absolutely. They see it clearly.
I mean, if I am a foreign central bank and I'm holding hundreds of billions of U.S. treasuries, I am terrified of this debt spiral.
You'd have to be.
Right. I'd be looking for a way to insulate my national balance sheet with an asset that isn't someone else's liability. I'd want an asset with zero counterparty risk, which explains why we are seeing this historic pivot into gold. Am I connecting those dots correctly?
You are connecting them perfectly. That concept of counterparty risk is the driving force here. For decades after World War II, the U.S. dollar accounted for the overwhelming majority of global foreign exchange reserves.
The default standard.
Right. But that share is steadily declining. Emerging market central banks and even several advanced economies recognize that holding digital IOUs from a heavily indebted government is a massive vulnerability.
Because a treasury bond is ultimately just a promise to pay you back in dollars that are continuously being debased.
Exactly. And when you factor in the rising geopolitical fragmentation, countries observing how financial sanctions can instantly freeze sovereign assets overnight, the desire for a neutral hard asset skyrockets.
Right, because gold carries no counterparty risk.
None at all. It doesn't rely on the fiscal discipline of a foreign politician, and it cannot be arbitrarily canceled by a foreign banking system.
But how does a central bank physically execute this? I mean, they aren't logging into a brokerage app and buying a few shares.
No, definitely not.
They're buying hundreds of tons above the long-run average. How do you acquire that much physical gold without completely breaking the market?
Well, they execute these purchases through massive over-the-counter networks. Often they're buying directly from sovereign producers or through highly discrete institutional channels.
So it's all happening behind the scenes.
Mostly, yeah. They accumulate these positions slowly over months and years, specifically to avoid spiking the price against themselves. But the sheer volume is impossible to hide completely.
The footprints are just too big.
Exactly. We saw record-setting accumulation in the early 2020s, and the current pace remains unusually heavy. It signals a fundamental shift in how massive institutions view the function of their cash reserves versus hard asset holdings.
And that institutional anxiety is definitely bleeding into the broader market forecasts. Doug Young's analysis references major financial institutions floating some genuinely staggering numbers, projecting gold to potentially trade above $6,000 per ounce later this year.
Yeah, those are big numbers.
Very big. What specific mechanics would actually drive the price that high?
Well, a target like $6,000 is highly contingent on a specific confluence of events. It generally assumes a scenario where the Federal Reserve is forced to aggressively cut interest rates despite inflation remaining sticky.
Which would hurt the dollar.
Right. And then combine that with a sudden escalation in global geopolitical conflict, which drives panic buying into the metal. It is not a guarantee.
Sure, it's a model.
But the fact that major conservative institutions are even publishing those models tells us that the expectation of severe currency volatility is mainstreaming.
Now, to be clear, this doesn't mean central banks are completely abandoning the dollar, right? We aren't looking at the end of the dollar system tomorrow.
No, not at all. And that nuance is vital. They are not dumping their dollars. They are hedging them.
Oh, okay.
They still need dollars for global trade settlement and liquidity.
Yeah.
But they view gold as the ultimate balance sheet stabilizer. As the debt loads of fiat currencies grow heavier, the allocation to hard assets must proportionately increase to maintain stability.
Okay, let's bring all of these macroeconomic forces back down to earth. We have massive government debt-trapping policymakers, global institutions hoarding hundreds of tons of gold to protect their balance sheets, and everyday savers bleeding purchasing power through negative real returns.
It's a lot to navigate.
It is. So what does this all mean for the listener trying to navigate their retirement strategy right now? Because the rules of the game are clearly changing.
They are changing rapidly, and the complexity is only increasing. If we look at the financial headlines from just this week in April 2026, the landscape for retirement planning is incredibly fluid.
Yeah, I was looking at those.
We are seeing headlines about financial advisors warning of hidden pitfalls in traditional 401k structures, even as account balances look nominally high.
And the regulatory environment is constantly shifting, too. I mean, we are seeing headlines about new tax rules forcing some savers to pay taxes upfront on certain retirement accounts,
Right.
along with proposed political changes like Donald Trump's new proposal for a federal match up to $1,000 for seniors. It feels like the entire framework of how we save and how we are taxed on those savings is up for debate. just reporting the headlines here, but it's a lot to keep track of.
It is. And with that level of fluidity in the regulatory and tax landscape, the core takeaway from Doug Young's research becomes incredibly relevant. There's simply no one-size-fits-all asset anymore.
Right.
The traditional assumption that you can just park your money in a generic safe haven and ignore it for 20 years, that's dead.
Because the nature of the risk keeps changing. What protects you from inflation might be completely useless if the market seizes up.
Which brings up the critical distinction between inflation risk and liquidity risk. We've talked extensively about inflation eroding your purchasing power. But a liquidity crisis is a completely different mechanism.
Let's define a liquidity crisis for the listener, because liquidity is one of those terms finance people throw around constantly.
Right. Think of it like owning $1 million home outright, but having zero cash in your checking account and suddenly needing $5,000 to pay for an emergency medical procedure.
Oh, that's a stressful situation.
Extremely. You possess significant wealth, but you cannot slice off your front porch and hand it to the hospital. You lack liquidity.
Makes perfect sense.
In financial markets, a liquidity crisis means you own assets that have value, but the market is so panicked that there are temporarily no buyers. You cannot convert your wealth into usable cash when you desperately need it.
So an asset like real estate might be a great hedge against inflation over a 10-year horizon, but it is terrible during a sudden liquidity crunch. Which means building a resilient portfolio requires asking yourself some very uncomfortable objective questions.
It requires calculating your actual exposures. First, what is your ratio of inflation-sensitive assets, like commodities, real estate, or equities, with pricing power, compared to fixed income assets like bonds?
Okay.
If your portfolio is heavily skewed toward fixed income, you must calculate whether those yields are actually outpacing the real-world inflation of your specific household expenses.
And second, looking under the hood of what you actually own. Are you paying massive fees for complex financial structures that magnify your risk without offering transparent, easily understandable benefits?
Exactly. Which is why seeking out a fiduciary-aligned professional is more critical now than ever. A fiduciary is legally bound to put your financial interests ahead of their own commission structures.
That's a big distinction. Huge. You need strategy, not sales pitches. You need advice tailored to your specific timeline, your tax liabilities, and your personal risk tolerance.
And you also need to build your own educational toolkit. You cannot outsource your critical thinking. One of the resources we pulled data from today is excellent for this kind of independent baseline research.
Absolutely.
If you want to dig deeper into the actual data behind hard assets and see how different institutional options stack up, you can visit the Gold IRA Companies Bulletin website. It's at goldiracompaniescompared.com.
Solid resource.
Yeah, it provides factual, comparative data to help you understand these specific markets without all the promotional noise. That is goldiracompaniescompared.com, and we will definitely include a link to that data in the notes for this deep dive. Transparency is the only way to navigate a shifting system. The macroeconomic forces we've discussed, the compounding national debt, structural inflation, the central banks diversifying their reserves, those are massive tides that are completely out of your control.
You can't stop the ocean.
Right, but how your specific portfolio is engineered to absorb those tides, that is entirely within your control.
Well, let's synthesize the journey we've been on today. The almighty US dollar is not vanishing in a puff of smoke tomorrow. It still commands immense tactical strength as the ultimate liquid asset during times of global panic.
Correct.
But underneath that gleaming exterior, the long-term premium is steadily cracking under the crushing weight of historic post-World War II levels of debt and sticky compounding inflation.
Yeah.
The invisible squeeze you feel at the grocery store is real, and because the government is trapped by its own massive interest payments, the aggressive 1980s playbook to fight that squeeze is largely broken.
This raises an important question, and it's an exercise I highly encourage you to undertake this week. What is the actual mechanical inflation rate of your specific household?
Love this idea.
Do not rely on the broad headline economic numbers reported on the evening news. Pull your last 3 months of grocery receipts. Look at your utility bills and your insurance premiums year over year.
Get the real data.
Yes. Once you calculate your personal inflation rate, compare it to the after-tax yield on your savings. That is the only way to accurately judge if you are growing your wealth or quietly falling behind.
That is such a vital grounding exercise. And as we wrap up this deep dive, I want to leave you with one final profound thought to mull over something that stems from the data we've covered but pushes into the future.
Okay.
We talked about how the world's most powerful central banks are hoarding gold to eliminate counterparty risk. Well, if the nations aggressively accumulating the largest reserves of hard, zero-risk assets are no longer the same nations that project the largest military power. Wait, let me rephrase that. If they are no longer the same nations, what happens to the global balance of power when financial leverage and military leverage are no longer held by the exact same players? What assumptions about safe money do you need to unlearn before your retirement?
Wow, that is the defining geopolitical question of the next decade.
It truly is. Thanks for joining us on this deep dive. Keep questioning the headlines, keep doing the math on your own reality, and we'll catch you next time.